Good afternoon, everyone. Welcome to our Selecting an Option Strategy webcast today. I'm Connie Hill. I'm happy you would join me here today. You know, last week we attempted to take advantage of high implied volatility. We attempted to sell some premium in a front week on some calendars. How do you think they did? Anybody paper trade those along with me? To see how they fared? Well, we're going to follow up on them, as well as maybe take a twist on maybe how we might approach trading a double calendar. Last week we had a survey. You guys gave me some great ideas. We will be implementing some of those ideas in future weeks. Now, I am joined in the chat, I believe, by Ben Watson. Ben, thanks for being here. As you have questions that are pertinent to our discussion, go ahead and chat those in. All right, Ben will help me answer questions. I really try to keep paying attention to the chat so I can answer your questions as well, because sometimes it needs to come from me. All right, so please let us know if you're listening to this on the recording, and I know lots of you do. If that's the case and you have a question, put it in the comments section of YouTube. I'll go back and check those throughout the week so you can make sure you have your questions answered too. Now, I hope you're following both Ben and I on X. Ben is Ben Watson CS. I'm Connie Hill CS. We'll put some educational content out there. Sometimes we observe things in stocks that we think are interesting that we think you might find interesting. So we'll go ahead and post about it. So it's free, follow along, get in on those little tidbits. Let's go through some brief disclosures, and then we'll lay out the agenda and what we're going to do here today more specifically. Options carry a high degree of risk and are not suitable for all investors. What we talk about today is intended for educational and informational purposes only. It shouldn't be considered a recommendation of any particular security strategy. Schwab doesn't recommend solely using technical analysis as your sole means of research, although we do use it quite a bit in some of our option strategies. Investing involves risk, including loss of principal. Spread trading must be done in a margin account. Multiple leg strategies do involve multiple transaction costs. That's a consideration everybody wants to just have in mind. Past performance of any security or strategy does not guarantee future results or success. One difference in the paper money as you're experimenting that's different than your live trading account is that short options can be assigned at any time in your live account, regardless of the in-the-money amount. With the paper money, it does not assign short option positions early, which actually ties back to some of our positions that we have that we were not assigned early. There's no guarantee that an execution of a stop order will be at or near the stop price. All right, a couple of events coming up. Ben's going to be at one or more of these events. I know he's going to be in the Chicago Market Drive event along with Kevin Horner. Will be out. That'll be August 17th. If you're anywhere near there, go ahead and go. You'll thank me later that you took the opportunity to go to a free event where you get treated pretty nice. Okay, we feed you and everything. Second one will be in Anaheim. That'll be September 13th. And then we'll have a workshop, option strategies and technical analysis is in Miami towards the end of September. So if you're within a quick drive, quick fly, you might consider taking advantage of that. All right, did anybody put a wager as to how our trades did last week? Where we did a calendar, we did them really short-legged. We were selling the current week that had a ton of implied volatility in it, and we just bought the second week out from that. Okay, I'm going to show you the results. And they turned out pretty good. All right, we will take a look at market conditions because that's helps us determine maybe what kind of strategies, it really plays into what kind of a strategy we might choose to select. So we'll talk about maybe what some current strategies might be that you might be looking at. Of course, we're going to do a lot of examples out on the platform. Now, as far as our option strategies go, you know, we've got some bullish ones, some bearish ones, and some neutrals. This week, we had a lot of volatility in the market, right? Like we really have not seen for a while since we have been together. A lot of sharp moves, both down and back up. And today, we've gone up and down. All right, so you're seeing that volatility come into play. When we see that, typically, if the VIX is up a little bit, implied volatility is going to be priced into your options, which means they're going to be a little bit more expensive. Sometimes that can be helpful if you're a seller of options, because you know that maybe that premium's a little bit juicier. So our strategies that we worked with last week were this calendar spread, and we're going to talk about it again today. I told you it would be like a 2 or 3 week series that we would spend on this as we explore some different ways you might use the calendar spread. We're going to do something a little different for our next trades than what we did for our last week's trades. Well, let's go ahead. Let's start looking at the markets, see how things are firming up here. And let's go to SPX. Now, you can see the big sharp moves we've had in the last couple of weeks, right? Big gap day down, another big gap day down, maybe finding a little support here. It's interesting, around this 5177 area is where it had found support in the past and was up earlier today, up as high as the 5330 range, but now down about 100 points from that on the S&P 500. So seeing a little bit of bearishness. Now, this moving average is a 30, okay? I think something that might be helpful to you to see as well might be a 200-day moving average, a 100-day moving average. I'm going to keep our charts simple right now, but just kind of observe the price action that we have there. Now, let's just take a quick look at the NASDAQ, because the NASDAQ has been just as volatile. I want to say it has been one of the more volatile indices, right? And it came down quite a bit lower. In fact, just for fun, I am going to throw on the 200-day moving average. We'll just create it here and use it for a minute. And we'll make it 200 days. We can make it, it can be green. That's fine. I want it to be a little fatter. So it dipped down right to the 200-day moving average. Hasn't seen that in a long time, has it? Yeah, it's been so bullish. It has not been down around there, but seemed to maybe find some support there, maybe bounce off of there a little bit. We'll see if it really is going to continue to follow through, or if we just add a little run up and now we're pulling back some more. Okay, we'll see how that plays out. Volatility. VIX. Hopefully you, in times like we're having where there's some volatility, it might be common for you to pull it up every day, right? And just kind of see what's happening. The chart looks really scrunched now because of what we had a couple of days ago with that high implied volatility getting up there at one point in the day to 65, okay? Whereas we've been roaming around with highs in the high teens, right? So boom, that was a huge implied volatility change, more puts buying than calls buying, which is what that ratio reflects, the put call ratio. In any case, it's bouncing up a little bit. It's pretty close to where we closed last night as far as the VIX goes. And it's been creeping up a little bit more as the market has been selling off and giving back the gains that it had earlier today. All right. Yeah, BJ says VIX is at 28 right now. It is. And like I said, it really kind of skews our chart, because if I don't pull in that day, oh, I didn't want him to be in here. Let's try it again. Let's try it this way. Oh, I'm trying to get rid of that guy. I want you to see some movement in there, right? Because our teens have just kind of been 18, 19, and then they really skyrocketed. But really, what we're looking at today is like, well, it's making its way back down to our recent highs, not there totally. So what kind of strategies do you feel like might be best in our current market conditions? Do you feel like, geez, the VIX is high? You can answer and give me some ideas in the chat. I'm happy about that. You know, are you thinking, man, the VIX is high, we should sell premium? Man, one thing you may have noticed on Mondays was how wide the spreads were, right? They were in a volatile environment. They spread out really wild. or wide. And then when the volatility settles down, they kind of come back in together. But for a period of time, you're used to seeing something that has a nickel wide spread and it's out there at 50 cents. And you're like, whoa, I'm not used to seeing this. If you felt like maybe you weren't comfortable making a decision which way to trade, you don't have to trade every single day. Sometimes you might get in the habit of that, those of you that are more active traders, but you don't have to, right? You can kind of set aside and do some assessments of what you think the market is doing. And if you wanted to experiment in paper money, or maybe experiment with just really small positions in your portfolio. All right, so Casey says, yeah, selling options seems like something that might be a good strategy. Now, we're going to go take a look at how our calendars did last week, because it's going to bleed into our discussion of the calendars that we're going to do this week. All right. So first one up is Qualcomm. And I've done a little bit of drawing in my charts. And actually, I think I'll leave that 200-day moving average there for us. Qualcomm had earnings coming up. And do we know what direction it's going to go with earnings? We don't. We really, truly don't. We had a market maker move on that, and we put our strike prices out by the market maker move. Now I'm going to flip over to what our trade looked like on Qualcomm before I got out. Okay, so we did 2 contracts. We've sold the front week here. We did 190 call calendar and a 165 put calendar. Well, if the stock dropped, which it did, our call calendar is not going to be worth that much, right? It becomes out of the money. Strike prices don't really bring in that much. And what we ended up doing here is the stock dropped down to near where our 165 put was. And so what I did, and I'll show you here, we got out the next day because it was at the 165 price, and then it kept dropping, which actually was not getting us better returns on it, because the peak profitability point is if you can get something close to where your strike prices are on that double calendar. Okay, so we ended up with a decent gain on it. We initially got in for 74 cents. We sold it for $1.34, which is about a 55% profit overnight. Now, is that something that is interesting to you, to have a 55% profit overnight? It's interesting to me. Should we plan on it every time? No, we shouldn't plan on it every time, okay? Because we just never know. So let's go back to the chart here as part of our learning. And so we basically watched the earnings, watched it come down. I'm going to put my mouse to where it went. We had 165 was our strike. Let me see if I can, okay, that's pretty close where my mouse is now, about 165. And so we came down, it went a little bit lower, and then our profits were kind of melting away a little bit, and then it started edging back up. And that's when we decided, okay, we'll take that 55% and be happy with it, move on to the next trade, right? Because the intent there was to capture the volatility, and we were able to do that quite a bit. Now, the other trade we had was Etsy. And on Etsy, I didn't take a screenshot when we finally got out of it, but I'll still tell you the story. On Etsy, this was the day we got in, right, a week ago in our class. It announced, I think it announced that night. The next day it gapped down and it continued to drop, and it actually got quite a bit lower. Gap down the next day. We stayed into this on Friday, so the profit was near that strike point. Let's go to, okay, brought up our Etsy here. We were doing the 72 call, which ended up not being worth very much, and the 58 put. Okay, so here it was down here around 58. And during the day, as it was trading, it looked like it went down to the 58, but then it started forming a hammer-like formation here. A hammer-like formation typically can be a reversal sign. Okay, and so it was looking like, maybe it's not going to stay in that 58 area. it's not going to do exactly what we want it to do. And so then we made the decision that because it was starting to form something that was looking like a hammer, that it was moving away from our 58, let's go ahead, let's just get out of the trade. And we sold our put side. So as we come back here, the entire spread, we spent about 76 cents for. We sold the put calendar only for 104. And then I want to show you what we should do with our remaining leg, because I didn't close it out because I wanted to treat them a little bit different. And so we still have our long call leg on Etsy. Now, have you guys seen, you might be thinking, well, why is it still in there, Connie? It's not anywhere near that 72 area. And that's right. But have you ever seen stocks that wandered a little bit, like they went one direction after earnings was announced, maybe that night, maybe the next morning, and then they reverse and they head up the other way? That was the reason for holding on to this, in case it did something like that. In case it reversed and went up, maybe we can make a little money on this option we weren't planning to make that much money on. Okay, so earlier we put in an order here for, I believe it's about 10 cents. Actually 5 cents. It's saying it's trading around 10 cents, but it hasn't filled us yet. But if it pays more than what you are going to be getting charged a commission for, then sometimes it can be worthwhile to just sell it for a little bit of peanuts and then not worry about it. Now, one of these trades I wanted to show you what would have happened to it if we had held on to it. Okay, so that is going to be, let me just take a quick look here. Not to our working orders, but let's go to our account statement. And it was on the Qualcomm. I think it was on the Qualcomm. It was like, Qualcomm, we knew that it was leaving this area. Maybe it was, this is Etsy, I'm sorry, Qualcomm. Let's change the chart back. Notice it's kind of in that 165-ish area. In fact, it's still kind of in that area. Okay, I think it would be worth more now than maybe on the day we got off. Well, we're always going to have that front put expiring, right? And so really there's some money in there, but not enough that it's getting us out of the trade, okay? Because I've tried that. We go back to our monitor tab, activity and positions rather, come over here, it's saying, yeah, maybe they'll give us 10 cents for it. It's not taking it, but maybe it will. All right, so we'll just leave it hanging out there. Now, any questions on those double calendars that we did? If so, go ahead, chat it in. Now's the best time to do that. Yeah, VIX is at 28. We talked about selling some options and TDs. Greg, you might be the one that was interested in some of those strategies, 0 days to options expiration. You guys did really good on responding to the survey last week. I've got a full page of notes of things that as a group you're interested in. Ben, this is going to take you off guard a little bit. But somebody in our class is really interested in the 0 days to options expiration. And I think fairly recently, I'm going to say in the last couple of months, I think Ben has taught a class or two on that. If you can find that, Ben, and maybe just put it out in the chat, there might be a couple of folks that were interested in that, might be interested in seeing it. Okay, we've got our 2 short put trades. Okay, these are just quite so interesting. Let's look at Procter & Gamble first. We still have about 9 days before it expired. We brought in $1.70. It's now worth about 46 cents. So we're up fairly nice in the trade, 70%. But did it start out that way? It really didn't. Look at this. The day after they announced, where did they go? Man, they just dropped right down to the gutter, right? They went shooting past our short put of 165. But you never know what can happen. So if we had been in a live account, there's the possibility that it could have been put to us, okay, at 165. We were okay with that. We liked the stock. That's why we sold puts on it. We wouldn't mind owning Procter & Gamble. But then a couple of days later, man, it just raced right past that strike price. And now it's up above it, and it's in a fairly profitable position. So we can decide what we want to do. We can say, well, I was just really most interested in collecting the cash. Maybe I'll let it bleed out a little bit more. Maybe somebody might say, I'm kind of happy with the earnings that we did get on it, right? Because we're up about 69, 70-ish%. But we could bleed a little bit more time value out of here, possibly, if we wanted to, right? Because Theta is going to be decaying at a higher rate. Currently, it's about what, $5 above our short strike price. And so, it could go either way. It doesn't expire Friday. If it expired Friday, you might be in a position where you're saying, let's wrap this up. I don't want to have something that's going from a decent gain to have some bad news or something come out, and then we're sitting with a loss. Okay. The advantage of closing the trade out now is you can lock in your profits on the trades, and you're not guaranteed that it's going to stay there. Okay. Now, the other one I want to show you as well, that was Hess. We did both of these on the same day. We looked at them. We knew that they were actually, they had a 150 strike price here, and it had just kind of looked like it was bouncing off that area. Well, oil after that has taken a step back, hasn't it? Our oil prices have dropped, and with that, so has this option. So we're down quite a bit on it, okay? Especially percent-wise. You're going to go, whoa, that's nasty. So what you might do is do the math. We don't have enough time to do all the math, but what you would want to do is you would want to say, well, if the stock's put to me at 150, and I receive, let's go to our account statement, bring it up, and our 150, we're going to have to, let's see here, maybe we have to go back a little further. We received 212 in premium. So if we put the stock at 150, then that makes our net debit in the range of about what? 147.82, something in that range, which isn't as, that kind of helps offset the blow. If we wanted to be done with the trade, and if you were like, I am absolutely against having the stock put to me, in a live account, it very well could be, we don't know for sure, but probabilities would be, you probably would have already been put the shares, okay? But if you wanted to get rid of it, you're going to see, well, look, come over here. And it's next week's option. Let's come out here. I want you to see how deep in the money it is. Yeah, it's going to cost a boatload plus a big spread to sell it. And so either way, whether we're put the stock right now or in the coming days, or whether we were to go buy it back, it will be a loss on that trade. We could have the stock put to us and we could say, well, it's loafing around. Maybe we just sell calls against it and collect some premium. We have the stock to cover it, right? If we were put the stock. And so that might be how some people might want to approach it. It was, I like Hess, don't like its price, but I don't mind owning it. So I'll own it for a while, and maybe I'll just sell calls against it to help reduce kind of that net debit expense. Okay. Any questions on those? Ben, thank you for pulling those out. Your 0 days to options expiration. I think that's going to make a couple people in here quite happy. All right, let's move on. Today's trades. We're still in earnings season. We still have, we've come through quite a few of the big names that we're expecting. We still have a few left coming up this week and next week, but not, I think the lion's share we're finished with. I don't know what the percentage is. But we have a couple that are kind of in a similar type scenario to what we were seeing last week. Okay. First one we're going to take a look at is Eli Lilly, LLY. Now I have on my charts, so this is our 200-day moving average. This is a 30. We've got our market maker move showing here. Okay. Do you guys remember that from last week. I will share, if you weren't here, I will share that script with you. You don't click on the script, but you copy and paste it up to this area, setup, open shared item, paste it in here, except get rid of my verbiage there that's calling it the MMM chart label. Okay, you just need the little URL there. Remember, scripts are not guaranteed as to accuracy and timing. And you just need to know that. If you want to use them, great. Could there be an error in them? Could be, right? We're not intentionally trying to send you something out, but you do need to be aware that it's not guaranteed, okay? So you could go ahead and then you'd put in import and remember what it's called, okay? I'm going to hit cancel. And we can see right now the market maker move on this stock is kind of big. Look at this, 812 down to 718. It's almost 100 points here. If we come over to the trade tab and we see, well, what's that market maker move look like? Yeah, about 49, almost 50 points. Okay, let's look how much pricing is priced into these front week options. Okay, we got 118% here. Next week out is 72%. Is that significantly greater? Oh yeah, that is significantly greater. And you'll see it kind of after we get a few weeks out, then it drops down to the 40s. But it's an expensive stock and it's been moving around quite a bit. So, you know, for the earnings trade, yeah, they're pricing in a big move. Now, if you didn't have the formula on in your chart, you haven't loaded that little script in, basically what you would need to know, it's just the at the money call and at the money put premium together that really prices in that move. Somebody asked in the survey, it might have been the survey or questions after our class, I went ahead and copied some of those down from last week, and somebody said, well, what's the calculation for how they determine that? It's a very, they have a pricing model that they use, option makers, market makers do, right? And they adjust the components of that formula based on kind of their risk that they're taking. So you could go look up the Black-Scholes calculator. You could go look up the binomial model. If somebody like really wants to get into the weeds with it, go looking for those formulas. And then if you want to dig into it, you can. Okay, but it's essentially pricing in the expectation for movement based on what the stock has been doing and the expectation for the news. Now, Eli Lilly had a great uptrend going on for quite a while until it peaked here 1st of July or 12th of July, and then has kind of started to have a short-term downtrend. Now, on earnings, we have no idea what they're going to do. What I was expecting here on this trade, we're going to do another calendar trade, but we do want to capture that front week premium. But what my intent is to hold on to it a little bit longer and then roll it, meaning extend the trade to other time periods beyond expiring tomorrow. So news comes out tonight. I believe it's tonight. If it's not tonight, it's tomorrow morning. Okay, it's tomorrow morning. News will come out, implied volatility will come crushing out of the options, and that's what we're hoping to kind of capture. But then if it looks like maybe one of our calendars looks good, we might extend the calendar, or this is sometimes when you change it from being a calendar to a diagonal. And so instead of selling the front month the same as the long leg, you might sell the I called it front month. It could be front week in our case. That front week, we might go a little bit out of the money because we think it's a little bit more realistic of a move for the time period that we're in. Okay, so that's what we're going to attempt to do with the calendars double calendars that we put on today. Okay, last week we captured the implied volatility only and got out. This week we're going to see what would happen if we extend the trade. And I'm hoping that we can. We're not guaranteed that it's going to set up that way for us, but that's what I'm hoping for. Okay, so let's go lay out this trade. Again, this is a little bit more detailed. If you haven't traded options for very long and you're feeling like, this is a strategy that might be a little bit hard for you, then make sure you stay in your paper account, right? practice in there, learn concepts in there. Same with these zeros data options expiration from Ben's videos. Practice out in your paper money account till you feel really comfortable that you know what you're doing, okay? Because it can require some adjustments, some rolling, some things like that, especially this one we're looking at here. Okay, so we do have this front week, has a lot of implied volatility, and what we're going to do here, we are going to sell this front week, and we are going to take this next week because I like the open interest here. We're going to open up both of these. The monthly expirations have quite a few more contracts, all right, than the one a week further out. Okay, so we're going to start it with the 9th and the 16th being our expiration dates. And where was our market maker move? Let's see if it stayed close to what I wrote down earlier. Earlier, it was looking like 820. Now it looks like maybe a little bit closer to 815 for a strike price. And then this is saying 717. So we're going to modify this a little bit based on where it sits right now. The strike price we're going to sell is for the market maker move. Do you have to choose those as your strike prices? No, you don't. Okay, you absolutely don't. But we're attempting to capture what's being priced in. That's what we're trying to do. So let's go 815 to begin with here. So we'll start out here. Here's 815. It looks like right now it's about a 24 delta. We've got enough open interest and volume here today. We're just going to do a couple of contracts. All right. And so I'm going to do a right mouse click and say buy. We're going to go to double diagonal and then come down here to double calendar. It's not going to change the verbiage to say double calendar, but don't let that bother you. Okay. And then it's going to just fill in the same strike price because it doesn't know what we want on the put side of things. Okay. So on the put side of things, you know, we're probably going to be up. We've got choices 720, 722. Let's see here. To 717 and change. So 718 technically would be the closest. So probably this 717.50. It's going to be the strike we're going to go with on the put side. Oh, that's right. I'm not so enchanted with the numbers of contracts out here. Okay. We really would like to be in a bigger pond of contracts for the contracts that we're going to do. So we've got to make a choice between going at the 715, so just a little further out or a little bit further in, or selecting off the 720s. Earlier in my preparation, we were going to do the 720s because that's where the price of the stock was. So we're going to adjust that. Okay, we're going to do 720, 715. It just doesn't have the open interest there. And I like what we have in the 720s better. So we're going to change on our put. We're going to change this to 720. All right, there's that put. This one, same thing. We're going to go 720. And we'll just do one contract here, okay? It's a little bit expensive. It is an expensive stock. So this trade is looking at 885 that we're hoping to be profitable with that. Now, we used the Analyze tab last time. We're going to do it again real quickly. Choose Analyze Trade. Come over here to our risk profile. And remember, peak profitability on calendars is the strike price that we are dealing with, right? We're buying and selling the same strike price. So here's our 720. Overall, this is going to cost us about $860. But man, if this thing were to go perfect and it were to go right smack to one of these strike prices, you know, you're looking here and you're like, oh, it's $2,000, possibly. And it could be, okay. Try not to be that optimistic with things though, okay, because once implied volatility comes crushing out, really what you see the next day is the tent drops. And it's kind of like you would have to be in there a lot, really close to options expiration on Friday if it stayed right at that price. And as you know, things wiggle around. And so you might say, well, let's look for a range, right? Look for a range. I mean, it's showing us our break-even points here. that looks like about 689.63 and 842.89. So that's kind of a wide swath, but we might say, don't be especially optimistic that it's really going to go that high and return that much. But if we could get a healthy percent, if you could get a healthy 55% or 60% like we did on last week's trades, that might make some of you go, okay, that's worth it to me. Okay. Rather than shooting for the home run. All right. So let's go ahead. Let's put it in. And we can just submit it from here. We're just going to do one trade. And let's just do a confirm and send. I'm gonna click on the lock here. So yeah, it's kind of jumping around here a little bit. Oops, no, I don't like that number. I like it back at let's put it in for 850. Let's lock it there, see if we can get filled there. Confirm and send, and off it goes. Okay. Again, the intent here for this trade is, yeah, we want to collect that implied volatility in the front month, but we also want to extend the trade. I want to kind of show you how that works. So hopefully it'll cooperate with us. Our other one, we're going to do two trades here. We have enough time to get our other one in, although we're not going to spend quite as much time on it. It's Datadog. Oops, got to spell Datadog right. All right, Datadog's information technology type stock. It typically has been making some big moves over earnings, and you can go back and look at that. It's got the market maker move priced here as well. Let's kind of maybe zoom in a little bit so you can see it's about here, about 118, 119, or down here at 96. So is it expected to move pretty big? Yeah. So let's see what we can do with that. So we're going to go to the trade tab, and I'm actually going to write these numbers down. Let's see, 119 and 90. I'm going to put 96 here. That's a little bit different than the ones I calculated it with prior to our class starting, but it's close. All right. Let's delete that. We send it in from the Analyze tab. Okay, so I've got our Datadog, and probably don't need this many options for this particular stock we did for the other. But in this case, we're looking at let's start with our 97. We'll start on the put side this time. And the strike price that it's the closest, actually, I started at 97. We're going to go with 96 because now that's the best one. Do we have some liquidity there? I'm not thrilled with the liquidity. I would like it to be a little bit bigger. It's not horrible if we just do one contract. It's enough if we do one contract, but I would kind of like it to be a little bit more. Okay, but we'll go ahead. We'll buy our double calendar. We're going to start on the put side this time. All right, so we're going to start with 96. And then on the call side of things, I believe it was up there about 119. So let's kind of scroll down. Where's our 119? Here's our 119. There's a little bit of volatility in here. This is a little bit wide, but it's expected because it's got earnings. Okay, they're going to announce earnings either tonight or tomorrow morning. And we've got enough contracts in here that we're going to just be the little fish in the sea. Okay, so let's go ahead. We're going to change this to 119 on the call side. All right, a little bit cheaper net debit here. So we're going to go ahead and do 3 contracts here. Okay, 1, 2, 3. We can do 4, actually. We'll do 4 contracts. All right, and again, expectation is capture that implied volatility. I didn't show it to you. Let me show it to you. 186 in that front week to 104 here. So we're looking like, almost 80%, 80 points of implied volatility. So these options are very frothy. They are packed with implied volatility that will come crushing out once the news is out. Okay, so part of it's to capture that, and then we're going to extend the trade here. Now, Chris says, would it also make sense to sell an iron condor around the market maker move over earnings? You certainly could, Chris, and that certainly could have been a strategy that I could have selected because of that. Because I wanted to do some things with some calendars because we haven't had the opportunity to do so. That's why I'm going with the double calendar strategy. But there could be a lot of different strategies that could make sense because of that high implied volatility and wanting to sell it. So yeah, an iron condor could be that. If you had a bias and maybe you only wanted one side, you only wanted the short call vertical or the short put vertical. It's been downward trending a little bit, but who knows what they're going to say. We don't know if it's going to continue or not. So yeah, that certainly could be the case. Absolutely. And we'll explore a lot of different strategies over earnings. All right, so we're going to send this guy in with our 4 contracts. Forgot to send it to our bucket. So I'm going to put this one in our bucket called option strategies. Off it goes. All right, we got filled on that right away. Perfect. Okay. Again, the idea with this, if you're trying to paper trade along with me, would be to, let's see what happens when the news comes out. Let's see how profitable that is. On Datadog, we actually have 4 contracts. We could maybe take some profits with 2 contracts and leave the other 2 on with the expectation that maybe we can roll those a little bit. It doesn't have to be all 4. We can choose what we might want there. Okay, so what you were asking about, Chris, an iron condor, selling selling premium would be more a neutral strategy here. Definitely fits along here with calendar. Now, calendar can also be beneficial if implied volatility ramps up, and if stocks fall, that's when they have a tendency to ramp up in price, and so our longer dated option might actually increase a little bit in value because of that. Okay, so we'll see. We'll diagram this as we finish up. Well, Ben, thanks for helping me out here today. I appreciate it. And thanks to each of you who have joined me for this session today. For you, if this strategy is a little bit appealing, maybe paper trade it. Experiment. You always want to experiment before you dive into it, right? So that you feel comfortable, like you understand it. You've gone into some situations where it went wild on you or it just kind of flopped around close at home. We looked at our market conditions, talked about using this specific strategy, a double calendar in this case. We'll go back and follow up with some of those examples next week as well. Now, Ben's playing double duty here. A couple things. Hey, JP, sorry. How and when do we get out of this thing? We watch it very closely like I did last week. We see where the profitability is. And last week, the intent was to try to close down the trade after the implied volatility came crushing out. Somebody asked this, and this is a good question. Let me go back to Thinkorswim here for a minute. Somebody had said, well, could we put in an order to buy it back? And the answer is we could, okay? However, to just close down the whole trade, we could say, oh, well, this is going to cost us on our Datadog. What did it just cost us here? Looks like we got in for like a 99-cent debit on it. So we got it a little bit cheaper, which is nice. And you could go in and you could say, well, okay, get me out at $2. If I get 100% return, great. I'm happy camper. Get me out of the trade. You could go in there and do that. But sometimes we end up unwinding these trades a spread at a time. Sometimes we don't. Sometimes we do. But if you wanted something in there and you're like, I'm happy with that, you bet. Go ahead, create a closing order, put it in there, see if the system takes it. Well, the system will take it, right? See if you get that order placed. See if that happens. And if not, then you can go in there and adjust it. Okay. All right. Well, you guys, Ben's coming up next. He's going to be talking about something so appropriate for this time of what we've got going on in the market about protective strategies. So we're going to have a little break here. Join Ben at the top of the hour, and I'll follow up with these trades with you next week. Thanks, everyone. Bye-bye.